There are people who argue, and justifiably, as far as I can tell, that it's been manipulated by, banks probably working in collusion with the government or the central bank to
Whatever it is. I
to
think
restrict.
that
Yeah, I can't prove that, but all I can say is it's wrong. And I don't think so. This time, I think there's a major difference globally, not just in the silver and gold markets, but they're expressing something. And that is that for about 100 years now, we've been totally on this fiat stuff, okay? Unbacked currencies. Roosevelt took us off domestically, seized gold, and Nixon banned it as a backing for international transactions. So gold was not the backing of the dollar in any respect. That was 79 for Nixon and the 30s for Roosevelt. So we've had fiat for that long. So the Japanese look at their currency. Same with the euro. It's just pieces of paper. There's nothing reality behind it. If that is failing, and we think it is, because it's led to nothing but monetary inflation, which has created what? Ongoing price inflation of certain assets, especially food and gasoline, stuff that hurts people. People get upset by that. And if you break this stock market now and put further pain in the average guy's face, his retirement account drops 20, 30%. And he says, oh my God, his wife gets laid off. Okay, et cetera, et cetera. You have a crisis that is broader than just silver and gold. They're expressing an outcome that's going to be different. I strongly suspect that when this event occurs, it will presage a piece by piece, country by country movement around the world out of fiat into gold-backed currencies. But it will take a crisis in pain to cause the public upheaval that will force that change on politicians and so forth. So yeah, I think when you get this surge, and if you're a trader or an investor, you might want to consider especially getting out of call options or leverage positions. But as far as dumping the metals again, I think we're going into a new reality where no, you're not going up to 200 and then back to 50. Okay. Okay. What we have here is a log scale price chart of silver going back to 75 and a logarithmic scale price of gold since 75. Both monetary metals historically for thousands of years. Silver is underpriced to gold, and we can see, you don't have to see the spread chart to see this. I mean, we've been in a 55-decade range of reality for silver. We nipped out above it, and then the feverish public finally said, I got to be in. They goosed it up to 53, and then they bagged those guys, which is justified. I mean, where were you? It just got in. Those old highs are meaningless, as you said, in real dollar terms. They're meaningless. But look what's happened to gold over the 50 years. An eightfold move from the 76 bear low. Gold was about 100. It's an $850 high. Boom, the first red arrow. Second one is from 2001 to about $260 gold, went to 1920. Another eightfold move, different span of time. But look, after each surge, there was a new range of reality, the gray the boxes, okay? And now we've started a third move here. If we match the other two log scale wise, it says $8,400 gold, just to equal what happened in those two moves. And given the background events right now, just equaling those would be nominal only. How come silver's still in the box? You think it's going to stay there? Look at the range from the 70s through 2005.
Yeah.
Silver was $50 capped then, okay? And why is it still there? Okay, now flip to the chart below. An even more exciting metal, lead. Okay.
Right. Well, which one? Maybe because of the strategic nature of silver, combined with the fact that 70%, 80% of all silver is mined as a byproduct, and it's very, very difficult to just start up new silver mines and get the needed supply. And so they've got to protect that a little bit more, maybe, than some of these others. I'm just guessing here.
Nobody can cap off reality ultimately.
Well,
they may try. I don't care how big the government is. It's coming down, or that agency will come down, or the policy will be proven to fail, and they'll give up on it. Nobody can restrain market reality ultimately. You can do it for a while.
Right. It can't be permanent.
If you do that, if that's a factor that has kept silver capped, then it's created even more dynamic in the compression factor that it's generated. So when we come up through there and prove, hey, you guys were wrong, we're going to catch up to reality. Well, those moves were different years, by the way. The up moves in lead was a year and a half behind the copper move. But they both were quadruples in a matter of what? A couple quarters.
So, it's like holding a beach ball underwater, to your point, but also,
Absolutely.
when you look at gold's move, you look at lead's move, you look at copper's move, and it's easy to justify. I mean, after the great financial crisis, they printed trillions and they degraded or debased the purchasing power of the dollar, which pushed these things up into a new reality. And then to your point, why has silver not followed?
Yeah, and I'm not going to get into that because I don't know. There are people who argue, and justifiably, as far as I can tell, that it's been manipulated by, banks probably working in collusion with the government or the central bank.
Whatever it is.
Yeah, I can't prove that, but all I can say is it's wrong. And when markets make major errors, like, every time we see a bubble top in the stock market, we never know it's a bubble. Some people do. Hopefully we do at MSA. But most people don't know it's a bubble until it breaks and they say, oh my God, that was a bubble. Why didn't I figure that out? Well, that's unreality for too long. And therefore, when it compensates, it usually does what? Overcompensates.
Right.
Similarly, in this lead and copper situation, when they were capped so low for so long, yet the money growth was a constant upward curve, and yet they didn't reflect that. They went sideways while the money growth went up, meaning the decay in the value of the money. And they said, oh, I got to catch up to that reality. Whoosh. Okay. Well, silver hasn't done that. Well, I guess it's a dog battle. You and I are wasting our time,
No.
Or
a market critically important.
Or a market has made a huge mistake. There's a chart at the top shows silver miners versus gold miners going back to 2020. And again, you had the silver miners surge, SIL versus GDX, in that 2021 surge in silver price. It went up a lot more than gold. So did the silver miners. But then since then, the silver miners underperformed the gold miners, GDX. But look what's happened since late 2022. 3 years. You've got a 1, 2, 3, now a 4-point trend line, and you're crowding it. If that spread this week, and already today, for example, GDX is down a little bit more than SIL is. So that helps firm that spread. You close out any month, this month or next, much above that green line. And the number is 94% divides SIL into GDX. And you have a breakout of a 3-year wide base, slightly declining base, but still a base. That will indicate similar breakout of the silver versus gold spread, which, as I showed, was close to a breakout also, which indicates just what you said. You break these guys out and it's telling you, oh, monetary metals miners, go to the silver guys. They're the undervalued ones. And there's like a vacant field above that chart where you can have open field running when you break out over that green line. Meaning silver miners could handily beat the gold miners on a percent gain basis. And I suspect, given the rightness of that structure, that's probably what's going to happen. The same is true with many of the key commodity components of Bloomberg. Energy sector, natural gas has been firming sharply lately. Crude oil is handful of dollars below a massive momentum breakout level. So all the components, the grains are starting to firm. Bloomberg is above right now as we speak. It's backed off from the price of Friday, which was 107.37. We're now in the upper 106s. You close out any month this year above 106.52, and we're above it right now with 4.5 days left in the month. This asset category, which is very cheap relative to historic prices, I note on the left there, 238 back in 2008, 175 in 2011. It's trading right now 106, 107, and they call this high. This has begun. This has only begun. That first leg you saw in 20 to 2022 peaked 1 month after the Ukraine-Russia war, so that didn't take it up. That topped it. Then you had a 50% pullback, and we based. You'll break out of the momentum base if you close above the 3-year average, which is 106.52, which has capped the action for the last 2 years. In other words, momentum says you're starting another wave. meaning from an investor point of view, one, you have a cheap asset category, especially relative to the stock market. Bloomberg. It's cheap in relation to its old price highs. It's cheap in relation to stocks. And in the past, there are times when the Bloomberg or the CRB index decades ago will follow gold. Not always. For example, 2015 to 20, Bloomberg went down while gold doubled. But now they're in position to follow on the footsteps of what gold is already doing. When is the last time, well, not the last time, but one of the more prominent times this occurred? The late 70s, global stagflation. Stock market was a total wasteland. Nobody made money for a decade. Most of them lost money. Bloomberg exploded on the coattails of gold. Not as much as gold, but huge move. So from an investment point of view, if I were looking for places to place money, monetary metals, emphasis silver, commodity asset category. If you don't like buying commodities, fine. Look at the stocks, fertilizer stocks in the ag area, other stocks in the agricultural area.
So just real quick,
yeah.
I'm sorry, just real quick. What's the impact in the real world for the everyday?
Oh, it'll hurt people because one, they've been promised by the newly elected president that he's going to keep prices down, meaning commodity prices, going to keep oil down. Well, I would say this. One, I think oil is probably going to break out. Already it's broken out over enough structures to suggest it's in process. The 68 monthly close does it, in which case all of a sudden those, quote, cheap gas prices at the pump aren't going to be cheap anymore. And they could go up fairly sharply, fairly quickly. Also, other food prices, which have been depressed over the last couple of years, as the Bloomberg has come back down, grains, for example, are going to reassert themselves. All kinds of assets in the commodity category are going to turn up. So it's going to hurt people and help generate emotion.
What's the probability that the break out of this is actually to the downside instead of the upside?
I'd say like zip. One, if Bloomberg right now were 150, 200 points, up anywhere near those prior highs, I'd say, well, it's more open to that. It's dirt cheap. You have to think about that too. Historically, it's dirt cheap. It is off the page cheap in relation to paper assets. And, perhaps it's been suggested to me by one of our silent partners of MSA that the world is about not just to favor gold and silver, but about to shift its focus again to the real world assets, which as a category are dirt cheap. We've been ignored. We don't care about them. And when this guy turns up for his next wave, the Bloomberg, which means like copper, which is pushing all-time highs again, it's going to impact people. And they're going to wake up to, hey, this is a category that's cheap. It's not going to get cheaper. It's acting well. And all of a sudden, this other category that I've been in for years gleefully has suddenly hurt me 20%. Oops, 30%. It's going to create an entire shift in psychology and perception of what is really of value in my life.
Yeah, that's well said.
It could be a decade phenomenon, where there's a man reverts to the real world with respect instead of disrespect. Okay.